Good morning, everybody, and welcome to Morning Market Briefing. This is Michael Burke. I'm Vice President of Client Training, and this is another edition of our Morning Market Briefing, today with Price Headley. Keep in mind that the following presentation is for educational purposes only. All of the symbols and trading ideas discussed by the instructor are for demonstration purposes and are not recommendations. Active trading isn't suitable for everybody. Options trading, doubly so. Please take a look at the risk disclosure information that I've pushed into the chat, and you can find additional disclosure information on the TradeStation website. What's going on this morning is that it's kind of mixed. Asia was mixed overnight. The Nikkei was down, but the Shanghai was up, so it's kind of mixed over there. We're still kind of trying to see what's going on with the trade negotiations and what the final outcome of that is going to be. So we'll keep an eye on Asia here over the next week or so. That's obviously, that overnight Asian market affects the European market, which is kind of up a little bit today. Going into the open here, though, it looks like we're going to be down a little bit, so keep an eye on that. Not a lot going on in news today. A couple of things. Masterclass. We have a masterclass coming up in the end of March. So this is a way to really kind of dive in and take a deep dive into the TradeStation platform, strategy trading, and easy language. These are really great events with really great feedback from our customers. It's kind of an intimate group, and we bring in a lot of great speakers, and it's really a fun week. So if you have a chance to come down and spend some time with us, it's at our headquarters in Plantation. I really encourage you to take a look at that. So today, Price Headley, founder of BigTrends.com. Price is a longtime friend of TradeStation. Those of you who've been in morning market briefings before know he's just an outstanding technical analyst and really has a great knowledge of the markets and trading. So Price, I'm going to turn it over to you.
Oh, well, thank you, Mike, and good morning, everybody. Always a pleasure to be with you on these TradeStation morning market briefings. It's been an interesting market. We're going to start off with the S&P, and then we'll go into the other major markets and then look at some individual stock ideas. I'm a big believer in converting stock and market ideas into option strategies. So we'll talk about some simple option strategies as well. What's interesting to me is I've been talking for weeks actually about how, the market coming up into these past highs there. You can see from right after the midterm elections, that SPY hit a 281 and change high. Then we hit almost a 280 and a half there at the beginning of December. So as we came back up here into that 280, 281 resistance about a week and a half to 2 weeks ago, we failed there. And then remember, when we started off this week, everybody was all excited about a China deal on this tariff situation, and that it was imminent and pending, and the market gapped up Monday morning, and then you see what happened. It shot down the rest of the day, came back late in the day, but then basically has been working off a little sideways to lower. We're right back into a 20-day moving average. That's a classic simple 20-day. But the thing that's interesting to me right now is look at this little pullback in the Williams percent R. We use it a little different way at BigTrends.com. We recommend that when it goes overbought and then the market keeps going up through that resistance, you can see if it goes overbought and stops, that's indeed a top of the range kind of a situation. But if it goes up overbought and then the market keeps going up, it tells me that the institutions here in late January were really wanting to get on board the bull trend with more conviction. And that overbought market is going to stay overbought a lot longer than you and I would expect. And that's where I've made my best money over time, is in trading these overbought situations. So the question becomes, if you've been off the train, you've been missing out on the market rally, and you're saying, well, how do I get back on board? To me, these retracements that I call retests, when it comes back under this 80 percentile overbought threshold, which it did at yesterday's close, we used the low of yesterday to say, okay, look, that's going to be a level at which we want to say we know we want to bet that if that bull trend is going to continue, yesterday's low should hold on a closing basis at the end of today, at the end of tomorrow on a daily chart. We look at the end of the day point. But you can see yesterday's low is 276.97. As Mike said, opening a little bit lower, but we were lower than this earlier this morning, and then Mario Draghi over in Europe, head of the European Central Bank, said that they were going to surprisingly start to help out the banks in some ways that weren't expected, and kind of turn the futures briefly positive on the S&P before now being at a slight loss on the SPY. But you can see that's right into that support level around 277. So my expectation here is that if we did get any morning selling pressure it's probably a buying opportunity on the daily chart. Now, we do use some intraday charts as well, but I'm going to kind of keep you focused on the daily just for the bigger picture trends. And my trade would be to trade it back up into that 280 resistance level. So when I'm thinking about if you have a defined, and so what's your stop going to be? It would be a stop if we have a daily close under that 276.97, yesterday's low. Even if it closes below there by a penny, I blow out the trade at the end of the day on a daily interval. And at the same time saying, what's my target? It's 280. Well, I won't just usually buy a call option in this kind of a case. I would usually look at something like selling another call overhead to reduce my risk. That's called a debit spread. So let's say that, if we were just thinking about the classic kind of option that I would be trading. Right now, the March options are a little bit close to do this. But, just as an example, let's just look at it because this would be just over a week away till expiration. I usually would recommend something about a month out, but I just want to show you how these are priced. If I was looking at, say, a 274 call, yesterday we closed at about 277 and a quarter. So the 274 call should be worth about 3.25 points intrinsically. What I love about TradeStation, as Mike said, I've been using it since the early 90s in its many different forms. I've been a big believer of the power of quantifying what you think it has an edge and actually testing it with easy language in the TradeStation platform over decades of data. And they've had option charts longer than most anybody else. So I've been tracking option charts, not just stock charts, and looking for these same patterns in the option, not just in the stock. You can see the SPY pattern here is not nearly as good on this call option. Even though it did break out, even though it did have a successful retest back in here on February 7th, you can see essentially these last couple of retests have sort of failed. You can see we've lost some of that overbought momentum, and now we're kind of back into more of a range trading mentality. So that right away tells me that if I do this trade, I don't want to just buy this option. I want to sell something else against it. So that was the right instinct to say it's not just a pure buy. The good news is it's also got the directional movement lines coming in for what I call a DMI kiss. They're just touching into each other at yesterday's close. The last time that happened was February 8th on that option. And you see that was a great chance to pick it up on the way to another pop and another pop higher. And I wouldn't be expecting this option to go more than about 820. That's the upper Bollinger Band, which is the last couple of highs there. So, but 470 to 820 would be nice. However, this is a riskier trade because there's not as much time in the option till next Friday's expiration. So what I want to do is I want to say, what if I sold? These are not recommendations, by the way, just showing you some ways that I think about things. And so I'm saying, okay, you know what? If you pay 470 for this option that I just told you was worth about intrinsically about 3.25 points, that means you're paying about $1.50 of time value. If you sell the 280 against it, well, that doesn't get back quite all of that $1.50. It gets back 88 cents. So we reduce our time risk by a little more than half in this trade. You still have price risk if you're wrong on the index and it breaks down below 277. If it finishes at 276 today or any day, you're probably going to lose a little bit on this trade because the time value is not going to be on your side. So you might even say, you know what, I'd like to even be more conservative than this. I'm going to say, what if we sold the, just to be really conservative, what if we sold the 278 calls that are just a point overhead now? And now you're talking about getting all your time value back. This is $1.77. Last trade, and this option, thus, if you pay $1.25 of time, $1.50, I think it was, and basically you're getting that $1.50 back and a little bit more. So what that's doing is it's saying, okay, that's the safer play compared to what I was just considering with the 280 call to sell against my option I would buy. The reason it's safer is because you're getting all of your time risk out of the trade. Essentially, if SPY stays flat here at 277. You're positioned to make a little bit of money, not a lot, but at least you've taken your time risk out of the trade. If it goes up to 278 or higher at the expiration, you bought 274, you sold 278, that's got a 4-point max value. And remember, you paid about 470 on the buy side at $1.70, just for a round number, you're in at $3. You turn 3 into 4, you make 33% on your money at 278 or higher come next Friday's close. That's not a home run trade by any means. But it's a more solid way to sort of take more of the excessive volatility out. Because if we're wrong about 277 holding on the SPY at the end of a given day, we would lose, and potentially bigger lose, if we just bought the 274 call. If we also sold the 278 call against it, then when if the market drops, the 278 call here is going to go in your favor because you sold that option. It's going in the wrong direction, and you essentially are helping offset some of your risk in just buying a call by selling another call against it. If it goes to the moon, you've locked in your best case scenario at 278, essentially that 33% return. So that's the downside of the strategy. You still can also lose what you put into the position, and if you were thus saying I can get 3 times as many contracts or twice as many contracts, you still have the potential, if you don't have good risk management, to lose what you put into the position. So you have to manage debit spreads with a clear stop, like you should with any trading strategy. So keep that in mind. But this is just an idea from an options perspective, kind of diving deep early in today's class. But to me, debit spreads are one of the best strategies for getting that greater consistency and still giving yourself some growth potential. A lot of people I know like to do credit spreads. We do some credit spreads as well at Big Trends. But the reality is that credit spreads are just purely an income trade. They're not going to get you any upside out of it perceived. If you have an edge, you think the market's at an important inflection point. Here, look at the Dow, the DIA. You can see a couple days ago, back on Monday's pullback, that low on Monday for the DIA was the retest low. You can see that was in that neighborhood, 256.2. You can see as of yesterday, look at where we traded down to. We traded to 256.45. And you can see that here we are this morning, right back in that 256.5 zone. So this is obeying that support. And you could do the same kind of strategy with the Dow and say, okay, I don't care about where it closed yesterday now on the Dow. Where I care about is how does it close against the Monday retest low. Even though %R is dipping some more over the last couple of sessions, it's when it has that retest, it's when you want to really put that focus on it. You can go back and study your charts. By the way, this is a 30-bar %R. A lot of the default Larry Williams percent range calculations are a lot of times 10 or 14 bars. I find the 30 bar is better on tests better for kind of riding that trend over a longer period. So you go back and look at last year, for example, and you'll see some tremendous phases on the way up with successful retests along the way that you could have bought the dips and taken advantage of that. And then when you're wrong, yes, you've got to stop it out quickly and move on. On the downside, we should look at some downside examples. Of course, you saw this breakdown that happened here December 14th, and then it closed below that. That's the bear confirmation that actually was at the close of December 17th. And then you saw the market keep plunging there dramatically, down about 20 Dow points. It's like, it's a pretty substantial, it's like a 2,000 Dow point drop in about a week. And then when it comes back for a bear retest, that's on this big rally day, December 26th, it's saying that high should hold. You see it doesn't. We close above it the next trading day. So that's your exit on the 27th. So these are the kind of things that tell you when there's a sweet spot on the upside or the downside and how you can take advantage of it. Of course, another vehicle that's just recently kind of changed trend a little bit is the gold market. GLD is the gold ETF that tracks gold bullion prices. And, from this perspective, you can see that we were getting that improvement in GLD all the way back here in early December, and then it closed above that high a couple days later. So there's your bullish confirmation, the first bullish breakout. A lot of times if you miss that first breakout, I say wait for the retest. So you can see the retest happening there December the 14th, again happening here a few days after that. And you can see these retest lows have to hold on a future closing basis. Then it came back in here January the 18th for another retest, went through a second one there around the 24th, held those lows, and then we took off again. Next retest, you can see how many times I kind of go to the well on this strategy. Came in for another retest here February 6th, rallied again. And this final retest is going to be where it will eventually violate. You can see that low is 125.05. So if we close under 125.05, there's your exit. Well, there it is on the 27th of February, 124.69. You're out of the trade at that close. So you caught from the initial first retest we were just talking about was in the neighborhood of 117. You went to 124. That's a pretty big move by gold standards. Again, remember GLD tracks gold bullion by about a factor of 1/10. So you're talking about almost $70 pop in gold prices through that phase for a 7-point pop in GLD. That's pretty healthy for that short of a period of time. So, you can just go through and you can look at everything else, the bond market in the same way. The TLT has been shockingly strong here recently, got weak last week, and now it's bounced back a little bit on kind of a flight to safety, up another 40 cents this morning. But you saw where the big trend was on the upside here back there when the market was tanking. Right before Thanksgiving, we got the breakout, and then we got the follow-through confirmation on the 19th, a couple days before Thanksgiving. Then we consolidated back into retest mode there, and then we took off again, had another retest that held from December 26th. The shocking thing was that was where the stock market bottomed, right, on the 24th right there. And yet bonds gave a retest. You would have thought they would have surely broken down, and yet instead we got another rally. So this is what I would call the structure of the markets, that when you see these retests, rather than worrying about every single tick on every single bar, when you just look at what I call the inflection points, the retest points are critical test bars. So like when you saw the bonds had been back into a trading range, then we hit up into the upper overbought boundary there February 19th. If we had closed above that high, yes, we're back into uptrend mode. Instead, it comes back down. So what I always assume is that it's a range when you're in a range until it proves to be a trend. And when you're in a trend, it's a trend and the retest should hold until it doesn't. So you kind of have to go with the flow of which is telling you that it's more of a trend or more of a range. So right now it's a range. We hit the low end of this range March 1st. Now we've bounced back. So definitely a trading range there for the bond market. Don't forget about the volatility index either. That's another one that tends to be more range bound. You can see it's been in a downtrend. It's just now coming out of that downtrend. So this retest that should have held here, actually it did hold yesterday. It looks like 1611 the day before yesterday. And I'll take it back. We closed above it at 1633. So that's now out of that downtrend. Remember, a downtrend in VIX is a downtrend in fear. That means you're getting a bullish cycle from mid-January when this thing first started to break down back here. So, that had been kind of some wind at our back for the bullish case, and now we're losing. That there's now a risk that volatility starts to firm up a little bit. At the same time, it's not into that straight vertical volatility surge like you saw that would confirm that bear trend I showed you earlier the week before Christmas. So when volatility is shooting up like that, you have a massive surge in fear, and that's where people are hitting the sell at any cost button, and you're getting this really sharp, quick decline potential. And so even though volatility is high, it goes even higher. We go from 24 to 36 in about 6 trading days. So that's the kind of thing that you can really take advantage of. Now, what about stocks? Of course, you've got all your big name stocks, and you can run through a whole host of these. Apple's been on a buy since right after its good earnings reaction back here in late January, early February. The gap up after earnings, and then the follow through that happened the day after. We had a intraday retest. It doesn't show as quite a retest under that overbought threshold, but it was there intraday, and we were recommending buying Apple into that dip just below, grinding up at 175. It's been tough. You see the bands, Bollinger Bands here. These are 20-bar Bollingers with the 2 deviations on each side of the moving average. So it just shows you that it's got a positive bias, but it's slow. And that slowness makes it tough for you to make money if you buy options. So we are looking for the faster trends. Compare that to, say, Microsoft, which, of course, like the S&P, is kind of doing battle with these old highs that it had back up here in the 112.5 zone. But it's been hanging above it a little bit, and, of course, it's been acting well after its earnings. You can see that the DMI lines are net positive. We're starting to get that green ADX line moving up, but I'd like to see it moving up a little bit more before I got the confirmation. But I would say Microsoft's got some potential to be a catalyst to the upside if it can get on through, say, this 113 level on a closing basis with some conviction. But the percent is already on a buy signal. So you can go through this same approach. Amazon's been in the news a lot because of Jeff Bezos has been very newsworthy lately. But the interesting thing is that the stock doesn't fit the buy profile yet. You can see there's tons of overhead resistance. The nice thing about the percent R chart is that when it gets going, it will oftentimes tell you to buy before you get the clear breakout through all the old resistance. So percent R will adapt, but the structure of this chart has been one that's been pretty much top of the range kind of behavior throughout this last several months. And then, of course, compare that to, say, Facebook, which, had been embattled. Now it's actually showing some pretty nice relative strength in the FANG universe. And we do a FANG options trading service just on the big 5 FANG names, with Apple thrown in there along with Facebook, Amazon, Netflix, and Google. Essentially you see Facebook's already got the %R new breakout. It did follow through. It's got the ADX starting to turn up from a low level the way I like to see it. Remember, it had the good earnings reaction on the gap up, but then it kind of went through a little cooling phase. So clearly it needs to clear the old highs with a little bit of conviction. We're just starting to do that. So it's down right now about 3/4 of a point, but remember, that next retest, probably a pretty good low-risk opportunity on Facebook. So of the big FANG names, that's one that's actually at the top of my list. Compare that to, say, Netflix, which has been acting poorly, compared to the good run that it had back in January, where you saw the breakout and then the immediate follow through, and then you got like a week's worth of upside continuation without even hesitating. And then there's your retest, and then that retest, sometimes it bumps around for a couple of days after a retest, but as long as it doesn't close below that 321 level, you're good to hang in there. So it might trade below there the next day, but by the close it's above it, and then we rally back up to the old high. So, it's been consolidating, and then we've kind of lost the driver on Netflix because the %R had its violation, right? That should have held about a week ago, and we broke below it on Monday's close. So I would not be seduced into this one, even though it's up a point. To me, that's one that needs some time to get that confirmation that we like to see. One of the stocks that we were picking up at the end of last week on a gap up on earnings, you can see is this Zscaler, ZS. This has not been a name that I'd followed that closely. It's in the internet security space, so it's definitely not a household name. But one of my trading room students pointed it out and said, that fits your profile perfectly, Price. And I'm like, yeah, it does. You can see that this one's been on a buy since well ahead of the earnings. And then you see that, look at how long it stays overbought and just keeps on slowly cruising up. Then we get the big gap. Then we had the pullback the last day and a half, and that low yesterday was the retest low, 56.70. So as long as it doesn't close under 56.70, we're good with this trade back to probably that 60 to 61 level. And we've got some 55 calls we bought against 60 calls we sold last Friday. So that's been one that's been interesting to me. As earnings definitely is my #1 fundamental catalyst. That when you see, and I'm not talking about the earnings themselves, I'm talking about the reaction to the earnings. So when you see a stock behave really well after its earnings, that means the institutions are going to typically be really wanting to come into that stock. So you want to pay attention to that and definitely follow it closely. When you think about some of the other big Dow stocks, of course, I'm thinking about technology first. I'm thinking about some of the names like Intel. Here's another one that had this sort of surprising negative reaction to earnings initially, but you saw that was in a bullish mode right before the earnings. So that was just a retest. That retest ended up holding, and then we ended up rallying on through. If you weren't sure about it, you could wait till the next breakout and then the next retest, which you see is coming in right off of, it's got to be below the 80th percentile, which you can see it was by the close there. So you see that's a really key test that subsequent day below that 48.68 level intraday, and then it closes back above there. I call that a bend but not break pattern, where it tries to break during that next bar, but then it flips right back up by the close. It's like there's a lot of battles being fought between bulls and bears every single bar, in this case every single day. And yet there's all kinds of battles fought intraday, but the war is won at the close. So it's basically saying if you're following a daily chart, the closes are what matter. Sure, I look at the highs and lows for these retests and breakout confirmations, but the close is telling me who has the ball by the end of the day. If you look at an hourly chart, you look at every hourly close. I don't like to look at 1 minute charts because you basically need a neck brace for the whiplash that you get from and not having to be able to move if you're that zeroed into your chart. I feel like a 15-minute chart's about as low as I would like to go in intervals. I typically am focused these days more on 30-minute charts for a lot of my intraday work. So it's kind of a hybrid between the 15-minute and the 60-minute charts. So 30 minutes is probably my favorite intraday time frame. So bottom line is that you start to look through. Of course, don't forget about some of the industrials in the Dow, like say a Caterpillar, that really hasn't been performing very well. So you can look across a lot of the ETFs as well and say, okay, what about financials, XLF? You start to just get some flair for where are they versus those last two highs. I just mentioned that the S&P is having trouble with that. That's underperformed, right? Because we bounced and we didn't get back to the old highs like the market did. at the start of this week. So financials are lagging. Industrials, XLI, they're a little bit stronger, right, or quite a bit stronger. They got well through that resistance. And so some of the names that popped up to me are like, if you see a name like, say, Cisco Systems that had those last two highs with the market, and then it cleared that, you can see with the gap up there mid-February. So this is one that clearly is outperforming. We made some money on some calls for our Option Shark Alert service last week. Just buying an in-the-money call that had virtually no time premium and just trading it up, just incrementally a half point, make a nice little quick pop and then move on. Usually with the big trends methodology, we're not into the quick trade scalp. We're more interested in kind of letting that trend run its course, because that's how you're really going to get paid as an options buyer, is by cutting your losses quickly, which is why I constantly reinforce that you should be using retests for your entries, because you'll keep your losses small, especially with using a leveraged instrument like options buying. And then when you're right, letting those correct trends ride. So you can see Cisco was down last week briefly, didn't quite show the retest by the end of the day. It was close there intraday. But essentially saying, that's a great accumulation pattern. Compare it to, say, stocks like Weight Watchers, which has been in more of a distribution pattern, right? So how about a bear example to give you a flavor of how that looks? So you can see that, yes, the stock's been down. You can see it's been oversold in the bottom 20% of its readings, giving you a lot of bear signals. Each time we come back above that 20% line, that would set my new stop. If we had a close over 30.83, I got to get out. You see intraday it was above there. We had a bend but don't break. It closed back at 30.48. And then it couldn't get through there. And then the next few days it had this big gap down on the earnings. So you'll see that distribution pattern can be just as clear. It just flip the rules over and look for the bottom 20% of candidates. And if the institutions want out of a stock, unlike you and me, where we can get out instantaneously on our whole position, if an institution owns tens of millions of shares, they're not going to want to be that 800-pound gorilla that splashes all the water out of the pool by just diving out all at once, right? Because they will hit rock bottom, the stock will tank, and they will not get out at their best potential average price. So they're typically trying to distribute that stock gradually so they don't make so many waves in the market and in the price action. So that's the kind of thing that you see, that those trends last longer than you would expect because of that gradual institutional buying and selling interest that's persistent. And so that's the kind of thing that I think is important to keep in mind, that the institutions drive the train. Our job as individual traders is just to stick with, following the big institutional money flow. So you look at a stock like Johnson & Johnson, they got hit by that baby powder arsenic news back here mid-December. It got knocked down for a little bit. It was in a short-term downtrend for about a week and a half after it followed through the downside the next day. So it dropped. We're in a bear trend. The bear retest happens right back here above 20, and it stops you out. You end up kind of scratching on that trade, maybe making a tiny bit, but not much on the downside. And that's because J&J is such a good quality company, right? But clearly, you got the breakout and then the follow through the next day here, late January. You got your retests. There's your all aboard good low risk entry there around 131.5. It retests that for a couple more days, and then it's off to the races, and now you can see pushing in near 140. So the beauty of this is that you can use this to trade all kinds of stocks. You just have to know where to look. A lot of what we do, I'm just on my trading laptop here, working outside the office, but basically so I'm not doing as much with the radar screen technology that I would usually do. For you to look at what TradeStation does with the radar screen is fantastic. You can go through and take, a lot of times I'll take 500 key weekly optionable names, and it can help me boil down to the best of the best breakouts and breakdowns. So when you're seeing that kind of news about something that's starting to move, you can pick it up intraday as well to really ride that short-term momentum. Like I said, it's a market. Let's just finish with look back at the SPY here, SPY. The market pulling back a little bit here, but the key is going to be what happens by the end of the day around this 276.97 retest from yesterday on the SPY. So we're right into that support. If it's below there intraday, I don't worry about it. I just say, look, if I'm a daily chart follower, I'm putting on that trade and saying, okay, now let's see if I'm right about it reversing. or not. And if I'm not, I get out. I don't ever justify a trade and say, well, the market will eventually catch up to my opinion. That's a fallacy. That's the kind of things that will get you in trouble. You have to follow a simple rules-based approach. And if you can follow your rules, if you have trouble following rules, I always tell people start with basically just paper trading if you have to just prove yourself that you can follow the rules and say, I would get out there, and then start really small when you prove yourself after at least 10 trades in a row that you can follow stuff exactly like you're supposed to, and then start with a small amount of money, and then make sure you can still follow your rules to the letter. If you don't, if you panic out right below the key support and then it flips up, and a buddy of mine in Chicago ended up retiring early because he said that all he made his money on was the morning flush, how they flushed out a lot of other traders, and they would take out those stops. The other people get sold out at the lows. All the big market makers and big players were buying right into that quick flush, and then it would reverse back up, and then they'd cash it in. So it's one of those things where it's like, don't get flushed like the other amateurs out there. Be aware of what your key levels are, what gets you out of a trade, what keeps you in a trade. It'll make you a lot more, not just consistent as a trader, I think it'll make you a lot more confident and not so overreactive. It'll help you manage your emotions better. So, okay, I'm not worried about tick action when I'm looking at a daily chart. I'm really looking at the bigger structure. So hope you enjoyed it. It's always a pleasure to be with you all. I'll hand it back over to Mike so you can get on with your trading day. Go out there and have a profitable one and a fun one. And profitable, but even if it's not profitable, if you follow your rules, that'll keep you in the game for the longer haul. So I'd rather lose small knowing I followed my rules than win randomly. And because if you win randomly or win when you don't follow your rules, you're just setting yourself up for getting taken out by times where you're not disciplined. Disciplined traders will always have an edge over those that are just in trading on hope. So it's always a pleasure. I look forward to seeing you back soon. Back to you, Mike, and thanks so much for the opportunity. Trade well.
Thanks again, Price. Always great. Thanks, everybody, for joining us. Thanks, everybody. Have a great day in your trading, and we'll see you tomorrow at Morning Market Briefing. Have a good day.